Welcome to the channel. This channel is using the principles and mental models associated with Charlie Munger to break down today's market headlines, earnings, AI hype, bubbles, fear, and volatility without the noise. Then we apply the same clear thinking to everyday decisions. Today, let's talk about the giant elephant in the room, the potential SpaceX and xAI merger. What does this actually mean for you, for the market, and for your portfolio? Let's break it down in plain English. Think of this merger as a massive tech sandwich. You've got SpaceX bringing the launch capabilities and the global satellite internet of Starlink. Then you have xAI layering on its artificial intelligence models, like Grok. Finally, it's all powered by a vision to potentially move data centers into space. It's a full stack from the ground to the stars. Launch, satellites, distribution, data, and the AI models, all under one roof. This is a classic case of vertical integration. As the great Charlie Munger would say, vertical integration can be incredibly powerful, but it can also be a fantastic way to hide bad economics inside a really cool story. Our job today is to separate the engineering ambition from the real shareholder returns. Even if you don't want to touch the big names like Tesla or Microsoft directly, the real money is often made in the infrastructure that supports these giants. It's the classic gold rush story. Don't dig for gold, sell the shovels. First up, the AI compute and networking suppliers. If a combined SpaceX xAI accelerates its spending on training AI and building out its network, companies like NVIDIA and AMD, which make the AI chips, are clear beneficiaries. Then you have Broadcom and Arista Networks, who are key players in networking and data center infrastructure. And don't forget Supermicrocomputer, which is highly sensitive to the AI server build-out. If everyone is racing to build the next great intelligence, the steady money is in selling the tools they all need to do it. Next, think about power. All these new AI data centers, whether on Earth or planned for space, need a massive amount of power and cooling. This is great news for companies like Vertiv and Eaton, who specialize in exactly that. If this deal triggers a new wave of spending on AI infrastructure, these are the names that stand to gain. And what about a more direct though speculative play? Some publicly traded companies can move just on headlines related to SpaceX. Barron's recently pointed to EchoStar as one of those beneficiaries. But be careful, these are tactical trades, not forever holdings. They can be incredibly volatile. Now, who gets pressured by this new behemoth? The most obvious are the direct AI platform competitors. A combined SpaceX xAI becomes a serious new rival for OpenAI, Google, Meta, and Anthropic. Reuters was quick to point out that this deal dramatically intensifies the competition among the big AI players for both talent and capital. Anyone whose business model relies on the idea of AI being a scarce resource might also feel the squeeze as a loud new buyer enters the market. Let's look at the impact on a few key stocks. First, Tesla. On the plus side, Tesla reportedly holds a small stake in xAI. The strategic story also gets stronger. Imagine Tesla's robotics and self-driving tech, powered by xAI's models and distributed via Starlink's network. It's a compelling narrative. But there's a big negative, and it's complexity. The more these companies get tangled up, the harder it is for us, the outside shareholders, to understand the real economics. And, of course, there's the key man risk. If the market feels Elon Musk is spreading his attention too thin, it could hit Tesla's stock price. The bottom line for Tesla? This adds a lot of narrative fuel, but also a lot of complexity risk. What about Microsoft? $1 trillion SpaceX xAI can compete aggressively for the best AI talent and for the same computing resources. Plus, Starlink gives them a unique distribution channel that Microsoft doesn't own. However, Microsoft is an absolute monster in the enterprise world, and this competition won't erase its existing contracts overnight. The market has already been a bit nervous about Microsoft's AI spending. So, while this news might add some volatility, it's unlikely to break the business. Google and Meta face similar pressures. They're now up against a new, formidable competitor in the AI race, which could force them to spend even more to keep up. But both have their own massive advantages, Google with search and YouTube, and Meta with its social and advertising empire. For them, the immediate impact is more about market perception and expectations rather than a fundamental threat to their business. So, how do you navigate all this in the coming weeks? First, don't trade the headline. Headlines fade. The real, lasting impact will come from the increased spending on AI infrastructure. This is where you find the second-order effects. Consider building a barbell portfolio. For your core, you can have quality cash-generating platforms like Microsoft, Google, or Meta. For the SAI part of your portfolio, focus on those picks and shovels companies that will benefit from the capex. Boom, no matter which AI platform wins, think NVIDIA, AMD, Vertiv, and Eaton. When you decide to buy, scale in slowly. Don't go all in at once. Split your buys into a few chunks to manage your entry price. And remember, your best risk control isn't trying to predict the future, it's proper position sizing. Finally, let me leave you with a bit of Munger-style wisdom. Anytime you see a big dramatic merger, remember, it's easier to build a story than to build economics. We don't get paid for excitement. We get paid for being right about incentives, costs, and durability. Thanks for watching. If you found this helpful, be sure to like and subscribe for more breakdowns like this one. See you next time.